Our opening panel is one that I'm really looking forward to. It is on navigating commodity super cycles, a macro metals perspective. We're very lucky to have Rigg, who is Executive Chairman and Head of ECM with Argonaut, Daniel Hynes, Senior Commodity Analyst, Commodity Strategist, with ANZ, and Kate Dickson, who is General Manager of Operations at AMEC. Please welcome them. I'll sit here, yeah. Pop this down here, I can reach it. I'll put it down actually. All right, so we'll start off pretty simple, I think, and just talk about what is a super cycle. It's a term that people use a lot. Some people kind of believe in it, if you want to use religious terms, and some people think it's a bit of a myth. For you guys, what do you see as a super cycle? And yeah, perhaps Daniel, can I start with you?
Yeah, well, I mean, in its purest sense, I suppose a super cycle would mean, a significant rise in prices. In a sense, we all look at commodity markets, on a price basis, and clearly that's the key factor there. But there's more to it than that. We can obviously get gains in prices due to a variety of reasons, but a sustained sort of pickup over multi-years is usually what we want to see within a super cycle. There's been a huge plethora of them over the past sort of couple of centuries, I suppose. But certainly since World War II, we've seen what we class as sort of three major super cycles. So post the Korean War in the 50s and post World War II as well. We saw a prolonged period of price gains there from probably 1950 to 55, driven by, I suppose, restocking post those two major wars. Then we saw in the 70s, Japan, the US, and other sort of developed markets really start to take off, which really propelled demand quite strongly through the early 70s, and then. The emergence of China in the 2000s, I suppose, was probably the biggest and probably the most influential in terms of commodity markets. So three major ones, which saw price gains of 400-500% over that time. So they were quite significant and altered really the commodity markets and the subsequent. Investment, I suppose, that we saw into the sector.
Kate, if we could come to you next, just that's a great recap, Daniel, essentially on what these super cycles look like. The current one that we're apparently moving into, what's driving that from your perspective, and is it in line with the kind of super cycle that Daniel's describing?
I think we're all seeing stuff around the world, wars. Access to commodities, it's all very complicated. I'm not an economist, but it's just the demand or lack of demand in certain commodities and the challenges around supply. And what we're seeing in Australia is particularly with nickel at the moment, is the geopolitical challenges around different sorts of commodities. It's all quite difficult.
Is it, and Eddie, maybe I'll come to you. We'll get onto the supply.
You want to go into the supply
side?
No, demand side. I mean, look, if you go through the super cycles, and they're all demand driven normally, right? Yeah. And they're normally driven around explosion, industrial development or urbanisation. They're the sort of two things which either go together or separately cause it. Whereas, in the 1900 in the early 1900, the 18th century going to the 19th century, you had the US. That was the first, most sort of more, recent 150, 200 year type super cycle. And that was about how they went from becoming an industrial power, and of course the rebuild of the wars, which was then demand driven, and then urbanisation demand driven. What's interesting about this one here is that it might be demand driven, but it's not necessarily because of an emerging economy coming through. It's maybe a change in the fuel we use to make us all live, right? Yeah. So is it demand driven because of emerging countries, or demand driven because of policy and politics on climate action? I don't know. I mean, they're just sort of something which is a bit different because all the previous super cycles have been driven by demand because of emerging or industrial, sort of almost industrial revolutions in those countries. Yeah. So it's just different, right?
I mean, you could sort of argue though that the energy transition itself may trigger that type of I suppose shift in the world economy. I mean, we're trying to electrify the global economy, essentially decarbonise it, and you look at some of the numbers that IEA and others sort of put up. It's a phenomenal amount of investment required to essentially re-engineer how we produce and use energy. So I think it's got the potential to create that type of level of demand. Whether it comes across a broad spectrum or it just hits particular commodities, will be the key to whether this is a very broad-based sort of super cycle.
I'll chuck one other thing that's interesting about the other part about what's a super cycle. It typically has to be across a broad range of commodities, right? What's really interesting in the last one is the real value of agricultural products has gone down, which is really unusual, right? So that has been an unusual thing. So metals and mining has gone up because it's commodity, right? We're talking commodities, but soft commodities, the real value of soft commodities has gone down. Right. So it's a bit unusual, right? So I don't know what happens going forward. Do we all start saying we want to eat, vegetables and grains, whatever, have been carbon free? So maybe it goes back up again. So it's an interesting thing to contemplate because the definition of a super cycle is a broad range of commodities, not necessarily oil and gas, so that's a bit separate, but of commodities. But we say in the last one, real value prices of agricultural products gone down.
So if we stay on the demand side for a second, because I know we do want to have a specific conversation around the supply response, but on the topic of a cycle, is this actually a cycle when you think about some of the demand elements that are in play? The idea of a cycle, obviously, prices go up because there's not enough supply, and then there's oversupply when supply responds, and then prices drop back down. If we're talking about a change in fuel sources, combined with things like urbanisation in India, although it will be less organised than China, are we looking at a new reality versus a cycle?
I think what we're seeing, particularly in Europe, like countries like Germany, who have a lot of industrial, processes, they've tried to move to renewables and electrification, but because of the energy prices there, they've had to sort of had a bit of a market correction around that, and having to rely on other energy sources. So kind of, I don't want to say step back, but kind of step back and look at other ways to get their energy source than through electrification and renewables, and seeing a lot of the energy mix in Europe, particularly around nuclear from France, supplying energy to all parts of Europe, and they're just changing that, rethinking how they get their energy because of the energy price.
Yeah, I mean, certainly that point though you raise about, are we just seeing a shift, I suppose, in the way it's consumed, rather than consume, or the population essentially becoming wealthier through that urbanisation sort of shift. And you did raise India. I mean, that's one where we do see starting to really emerge after several false starts, I suppose, over the past couple of decades. But is that going to drive global growth? It's only a relatively small economy, I suppose, compared to China and the US and other majors, so it may not ultimately move the dial, but that's what I would want to see, a rapid urbanisation of an economy to really drive that super cycle on a sustained basis.
So funny though, India though is a service economy, not so much an industrial economy, so you can't, I mean, if a service economy drives a super cycle, that'll be the first time, right? because it's always been in the industrial side, which drives it combined with urbanisation. Yeah, get urbanisation, but it's a service industry, so it's a bit different, right? So don't know. I actually don't know. I wish I did know, because I wouldn't be still working. I'd be sitting on a beach and just drinking, pina coladas. Yeah, pina coladas, right? So.
Supply side stuff, and we'll start with you, Eddie. Kate's already touched on it.
Yeah.
But the supply side response, maybe starting with what happens in a typical cycle, and then we'll move through what we're expecting this time and some of the nuances. And I think you've got a slide which is unfortunately going to project onto mainly Daniel's head, I think.
Yeah, so...
But I think hopefully we'll get the gist of it.
Moment.
Yeah. So people don't know, I mean, the firm I work for really is just a supply side group, right? We do a tiny little bit of demand, but really we leverage off other groups on what the demand side is. So, we've got lots of geologists working for us, I think 6 or 7 geologists, mining engineers, metallurgists, etc. And what we try and do is try and work out what the supply side response is. And what we're seeing is that, and what we're pretty certain about is most sort of bulge brackets and government organisations are getting it really wrong. The supply side isn't coming as fast as they think, and I love it. I just love it. I still see these numbers on lithium, right? They're just so wrong, right, about the supply side. I know. I go out to mine sites getting built. They aren't coming on production like they say. And when they do come on production, they don't get 75% recoveries. They get 55. Or Sigma, right? For example, in Brazil, they were suggesting 70% recoveries. They can't even get 35 on a real basis. It's going to go. It will go. It will go under, I reckon, pretty much. That's how bad it is. But if all these bright people and in big cities, etc., and governments had it producing X amount, right? I mean, people got. I won't say the names. I always get in trouble with these companies. But at least Sigma's offshore. They won't yell at me today. But there's. I go out to sites now which are due to come on production this year at a certain rate. It ain't happening. It's not happening, right? So going back a little bit more, is that why do we see that the supply side's so muted? And there's sort of 4 factors we come up with. And the first factor is really around, now it was globalisation and urbanisation in China sort of drove the process of this super cycle. But we're thinking deglobalisation now, because a lot of people don't want products, especially in the EV industry, with China as part of that supply chain. And so then we're seeing the US building up capacity in refining and lithium and nickel and rare earths. We're doing it here in West Australia as well. So there's this whole thing that people have to build these big pieces of kit to actually refine product, and that's going to take a long time. So we're seeing deglobalisation is going to continue this sort of period of time. The approvals process, and this is from, I think the quote is from SNL, and I think it's 17 years from discovery to in production on the larger tier 1 projects, right? 17 years is a long time, right? That means you're going to, before you could put a project into production maybe 5 to 8 years really quickly, but now 17 years is just a long, long time. Nationalisation of assets, we just saw recently with First Quantum in the Panama, all of a sudden there seems to be more of these countries whether it's South America or Victoria or even sort of Africa, where all of a sudden you make a decent discovery and then the government wants a bigger share of it and changes the goalpost, makes it challenging to finance. And then the other point is just ore bodies are harder to find. They're blind. I mean, the finding ore bodies at surface, there's very few of them found these days. And if they are, they're found in countries where it's very challenging to get finance and develop projects. So we're seeing these ore bodies taking longer and harder to discover, and then longer and harder to develop, and longer and harder to finance. So we're sort of seeing that the supply side is really dampened, and any figures you see, I just take one thing I wrote today, any figures you see based on what supply side's going to be, just don't expect it to be true, right?
Anyone want to add to that?
I mean, a couple of things I would note in addition to that. I mean, the inflationary sort of environment we're in at the moment means that a lot of producers are quite wary of capital costs and the like. So that means they're dotting the I's and crossing the T's a little bit more these days. It's taking longer. In South America, you've got the additional issues around power and water, which have to come into play a bit more now. I mean, having to develop their standalone energy supply and desalination plants, for example, just adds to the complexity of that issue around ore bodies becoming more and more difficult to find and operate. And also, I think executives, particularly of major corporations, are just a lot more cautious these days. Looking at the bottom line and the returns rather than that engineer type mentality. And I'm an engineer myself. I love building things and then blowing them up, so to speak. So that was what was driving a lot of mining companies in the early days. Now run by accountants who want a really good rate of return, and so that rising sort of cost base means that they're really looking at these projects a lot harder, and it's taking or adding, I suppose, to that approval process in a sense.
There's also an issue around the human capital, so getting people to do the work, and it's not just working on the mine sites. As part of the approvals process, we're seeing people being taken out of government departments to go and work at site because there's more money there, and so having the bureaucrats within the regulators to do the work and do the approvals is quite a challenge as well.
So would it be reasonable to say that in a normal cycle, even a normal super cycle, that rubber band is pulled back and then it gets let go? In this, because of these acute influences, we're still seeing that rubber band being pulled back and back and back. And does that necessarily mean that the result will be a larger upswing? Is that does it have to be like that?
Or longer, at least. I mean, it's an interesting point Kate raised there. And it goes further than so there's the skill shortage, right? Basically, having people want to do approvals but also do the mining, right? I mean, amazing stats. So in Western Australia last year, there was 126,000 people directly employed mining. So that doesn't include all the service industries and all the, because in WA there's lots of most of WA is mining, right? So, but the ones who actually work, 126,000 direct employees. To put that in perspective, government has 166,000 employees, so it's the second biggest direct employer, but I think with ancillary services it would be bigger than government, right? The biggest university in West Australia for mining is Curtin University in the School of Mines in Kalgoorlie. It's one operation, but in 2018 there was 248 people enrolled to do engineering, geology, mine surveying and metallurgy. 248, right? So they're graduating now, and there's a normal dropout rate. We've got maybe 180 qualified in an industry which needs 126,000 people. I mean, nothing against journalists, but I got these stats that I think Neil was here, Neil Marsden's here. He said he's somewhere in journalism there was 1,000 people enrolled to do journalism, and journalism's sort of changing, right? When you got 248 doing mining, and I know which one carries Australia. And so it doesn't make any sense to me, right? And it has to be something about government policy here to encourage it. In that time, there was, the number of people doing environmental sciences went up megafold, right? Really interesting talking last week to some senior people from Rio Tinto, and they were saying they're noticing now that people who got environmental science degrees are now swapping over to doing geology as a postgrad. And great. The other part about that was that gender diversity. Of that 248 who started, there's about 10% were females. So God knows how we're going to get 50-50. But the environmental sciences were more females, and they're coming across and doing geology. So let's hope environmental services delivers the geologists and mining engineers we need.
I'm glad you're talking about the skills issue. I wanted to get the AMEC view basically on skills, but then also what are the other fallouts that happen during the cycle, and particularly will they be exaggerated if we're in a super cycle now, or coming into a super cycle, I should say?
Well, yeah, the skill shortage, that's the fallout, and the cannibalising of people from other industries. So that sort of adds that challenge there. From an AMEC perspective and a policy perspective, trying to attract people to the industry is always really hard. There were a few discussions on it yesterday on how do we get more people into the sector and make it make it more attractive for people to be part of. That's always a challenge, and I think we're seeing a lot more people from particularly environmental sciences coming. They think they do environmental science thinking they're going to have certain sorts of jobs, and then they end up in the mining industry anyway on rehab projects and that sort of thing. So I think the fallout will be hopefully that we have a different type of industry that is more holistic. I think, can we go to the Lassonde curve? The next slide. We'll talk about the first part of that curve, but I think what we're going to see is we're going to see more mining projects extend that Lassonde curve into more rehab and repurposing of mine sites. So hopefully the super cycle will help make mine sites more, get more money long term.
Yeah.
So we're not going to have so much closure, we'll have repurposing as well, and maybe have energy projects come from.
Which we're looking to do in Queensland, right, where they're repurposing an old mine into a hydro facility, right? So, yeah.
We want to go back to the slide in a bit, but Daniel, I was hoping I could put you on the spot and look at kind of over and under investment during these periods. What are we looking at in terms of a fallout from the cyclical activity and where the money is actually being invested? Obviously, Eddie's talked to the idea that things that have already been invested in shouldn't be assumed to be coming online. What does it look like in terms of investment and the pipeline there?
Yeah, look, it can be impacted by how commodity markets behave. And, you know, these sudden surges in prices, while, you know, on the face of it will potentially attract capital, you know, end up being, you know, I suppose headwinds for the industry in general, because you tend to get these fallouts. You know, for example, obviously in the lithium market, we had prices hit record highs last year, and they're subsequently fallen by half again. That type of price action, you know, tends to put off the investment decisions of companies. You know, producers want to see, you know, more consistent sort of gains in prices rather than these in dips and troughs. Because you know, if you're a lithium producer now looking at a feasibility project, you're probably going to put in, or at least, you know, your accountants are going to ask to put in, you know, the low prices that we're seeing now, and that may not fly then that project under that basis. So there is a real risk, I suppose, that, you know, this real volatility we see actually delays investment. Clearly, though, you know, if prices continue to rise, then we'll see the flip side of that, and you know, we could then subsequently have a whole wave of projects hitting the market, which is obviously not great. But you know, I do sort of concur with Eddie in terms of, you know, that project pipeline always looking and essentially coming in well below expectations. But certainly, you know, the capital tends to rise, and ultimately at the peak of the market, you'll see the peak of projects coming in. But clearly, with, you know, that type of time frame to get a project to the market, it's going to come in when most likely that super cycle is over. Ultimately, you know, the industry should be investing at the cyclical lows.
But it never does, right?
Benefit from that.
That's the cycle. Yeah, that's the cycle.
Well, yeah, exactly. That creates a cycle in a sense, yeah. So, look, we know what market we're in. It's a cyclical market. So you've got to ride those highs and lows. But I do think, you know, the market is a little bit more attuned to that, I suppose, these days compared to the past, and that may result in some of those highs and lows not being as great as we've seen before.
Okay, and we touched on it briefly, government intervention. It's a prickly one. I know that Eddie's going to have a view on it, but I'm wondering, Kate, if we can kind of get just an overview, essentially, what you see from an AMEC perspective, again, as government roles, you know, when you're looking at the kind of challenges on the supply side, what's government doing at the moment, particularly in Australia? What do you think it should be doing?
Well, the different jurisdictions do different things at certain different phases. So one of the things that really affects our members is the collaborative drilling initiatives. So they've got different names around the country, but that early money really helps the explorers, and it pays. The studies show that it pays like tenfold over the life of the project, from discovery through to production. There's other things the federal government does around tax incentives for research projects. So there's different government money at different phases. Where something AMEC's trying to encourage the federal government to do at the moment is the production tax credit, which will give a 10% tax credit to producers. So they only get that credit once they're in production. It's not free money or anything like that. So encouraging that's to counteract what's happened with the Inflation Reduction Act in the US, where money's being invested in other places and not so much in Australia, where we want to try and have this stuff on shore.
Is that just for more of the critical elements, minerals? Is that, or are you talking about broadly right across all commodities, the production credit?
The request was for the minerals on the critical minerals list.
Okay.
And as we know, that list can change at the strike of a pen. So nickel's on that list now. Doing government incentives like that can really, really, really help the sector. And it's not a handout. It's just trying to level the playing field with what other governments are doing around the world.
I mean, it is a difficult situation. I mean, I feel that support at the start of the project is key. And obviously a lot of the juniors always do struggle for finance and capital, so that support is certainly welcomed. But you find in other jurisdictions, it can be a hindrance. I mean, in South America, for example, they're now forcing, I suppose, all project developers, for example, in lithium to have government involvement. So the national state-owned companies over there are essentially required to be partners, or are supposed to be a key partner of a lot of those projects, and that can then obviously be a difficult sort of setup at the time, and whether it aligns with obviously the project developers who are bringing it to the table, I suppose, is an issue. It can result in overinvestment as well if the government initiatives, I suppose, aren't aligned with what the industry is expecting. So, I think ultimately early stage support is key. After that, I think the market should drive where the investment goes.
I think there's probably more we can talk about around government intervention, good or bad, but I'm just conscious of time, and there are a few points that I really do want to get to. And might start, Eddie, talking us through what we're looking at here on that slide, and the research that Argonaut's done and why that's important.
Yeah, it supports what Daniel said, and I've got to say with Kate is, I mean, one of the policies I do, there shouldn't be any hex on geology, mine engineering, right? They should just, I know they could earn a lot of money down the track, but geez, we've got to get people there, right? So for AMEC, there's my idea for the day. So, but on the early stage, what this graph shows you is a very typical. So it's Pierre Lassonde came up with years ago, and there's different variations, right? But what we do know is the study phase slump, sort of the bathtub sort of area, where all the excitement's gone out of it, and you get into a real project, you've got a scoping study out or a pre-feasibility study out. That period's been made longer and longer, and it's more and more expensive, right? What the study showed, we went through and looked at every company which put out a scoping study from 2000 to 1 January 2000 to 31 December 2022. We went back and looked at each company and how they did. So it was a pretty big study we did, and there was 176 of those, right? Individual ones, and what it showed was that the best time to invest is in that excitement phase after discovery, right? And then, this is pretty obvious, but once it's all funded and you're off to production, right? But what was really interesting was that so many companies didn't take advantage of that that period and that discovery phase is, and I try and explain this to clients regularly, but I don't get through often, particularly if they're mining engineers. Because mining engineers have spreadsheets, right? Spreadsheets. Spreadsheets, and they go, the NPV of the project's this. Oh, God help me, it just drives me mad. I want to hit them. And I go, but guys, your share price is here, you got NPV here. If you don't have money, you can't develop your project, right? And what it shows in that first phase is it's typically investors think, this is exciting, how big is it going to be, how much money I'm going to make, right? And they fund it. So the more money you raise in that early, after discovery, before you do a study, the less dilution you have, the better decisions you make, and the faster you develop your project. And that's the study. That was the number one thing out of the study. The companies which raised the most money in the exploration phase built the best projects. And less dilution. I know it sounds counterintuitive because you're raising money earlier. It's less dilutive, right? Yeah. Because you didn't have to raise money when, because the moment you go past the scoping study, the mindset of the investor goes to all the risks, all the challenges, all the permitting, and have we got the team? How are we going to get this through? How are we going to fund it? The mindset changes, and a lot of investors just leave, and it's left with high private equity and some other long-termers, right? Or people who can't get out. It's a really interesting mindset.
So I should have said, Eddie, and to the audience, the reason I wanted to bring that up and make sure that we got to it was because obviously our audience, there are a lot of investors in there, and so the message, what would the message be? It would be if you want to trade out, essentially you're looking at this point. If you're looking to buy and hold, you want to look for companies that are savvy enough to raise money when they have the chance.
Yeah, if you go to the next slide, this is over the 22 years, the best companies either raised the most money, continued a dual strategy of exploration while they were doing the study work, because during study work, I can tell you now, most projects have the most lipstick on them and mayonnaise on them when they come out with the scoping study. There's very few positive surprises during a study period. I can tell you, very few. So, but if you have exploration, you can have that new discovery, right? The other one was joint ventures with majors who bring to the table all the things which de-risks the project, which always puts it at rest the investor's minds that do we have the right amount of capital? Do we have the right team? Can we get the permitting through when you've got majors have already got all those characteristics? And then there was this last one, which was an interesting one, where some guys, this only applies to underground operations, where they're able to start doing the things in the study phase during the exploration phase, but calling it exploration, right? That's a rarity because you've got to have an underground project to do that. There's been some really good examples where they call it exploration, declines, but really they're pre-production declines, and they're doing, it's basically setting up as a mine, right? And then they press the button, they're ready to go mining. So, but those, if you didn't do those things, it was really, really hard for companies, even if they had quite good people and quite good projects, it was really challenging, and the massive amount of dilution they incurred through the process meant they actually added no real value to their shareholders.
Okay. Dan, you're nodding along there. I imagine the ANZ research says something reasonably similar.
Yeah, no, absolutely. It's something that we look at quite closely. For us as a bank, the majors obviously present much less risk, but all of the upside, I suppose, is in the developers, and we do encourage that third point of joint venture activity. For us, the ultimate project is one with a major like a BHP or Rio, partnering up with Junior Explorer with an exciting sort of deposit to develop. It's got all the benefits of the backing of the major with a relatively prospective ore body. So that's how we view it.
That's something that you'd be encouraging investors to look for, is groups that have managed to attract these partners.
We always like this, but it's hard to get through the guys running a company going, but that means I won't be running the project. Yeah, that's right. That's right. But I want to be the guy who's in charge. Well, okay, let's think about shareholders. And I know this won't be as popular as some of the people in the audience, but I'm just talking about thinking about shareholders, right? And if you do that project where you develop to this stage and you bring a partner in, I can tell you your value as a company developer, a company promoter is so much stronger. So I can tell you, go out and do it again, give yourself a lot more performance rights, and you'll do better off yourself anyway. So anyway, I'm just sort of chucking that out there, right?
So lots of explorers, they want to explore, once they've found it, like explorers aren't necessarily project developers, and I think that would be. I would assume there's not many explorers who want to take it through.
No, they all do. They all do. Don't worry, they all do. Pretty much. So, give you an example. Gold Road's one of the few companies I know who absolutely, and they've got a great project. But that was a really good project. But they didn't build the team and like if you do want to build it yourself, you have to change your board because explorers and geologists and those sort of guys don't always make necessarily good miners. Some do, but you got to change your board around and make it very different. And so and not a company struggle with that transition. So the better thing to do is either sell the project or joint venture it. So
potentially speaks to the earlier point that you were talking about. The people aren't actually out there to make that transition, which is why it might be difficult. Yeah. And then the egos of management, really they should be consolidating to create better teams, but potentially egos don't allow that.
Some boards will change. I mean, a good company we're involved with, De Grey. I know De Grey's got a great gold project, but the people like Peter Holmes, and there'll be an announcement later this week, another person, but there's Peter Holmes, the ability to attract those sort of guys who build really big projects in other parts of the world to come back to Australia, like he's an ex-Australian, went overseas, built some of the biggest mines in the world, he's come back to project develop and put this thing into production. That's a great thing, right? Because he's the guy who's going to make it work. So.
Just conscious of time, we've got about 3 or 4 minutes left. I wanted to talk about the actual commodities that you guys are looking at or you think will do best coming into this next upswing in the cycle. Anyone? Sure. I thought you'd be jumping.
No, okay. So let's talk about. I'll just talk about my view on lithium, and we cover a lot of the lithium companies. I didn't expect the lithium when the lithium price was sub $1,000. Did we expect it to go through 3,000? We thought it might get to 3,000 on the way up, and then went to 3,000 and goes, oh, surely it can't get to 5,000. This is SC6. It went to 5,000. Then it approached $7,000, $8,000. Right? Ridiculous price. Yeah, not sustainable. Do we think it'll drop all the way back to $1,000? No. I mean, this is just a whippy action, right? Our sort of view is at the moment there's a price, some 5,000 tonne of SC6 or 5.5 was actually sold, equivalent price of $1,200 a tonne last week by Pilbara. So our view is it's a sort of like a $1,200 to $1,750 price, maybe low as 1,000 seesawing, but we think $1,750 is the marginal price of converting lepidolite into the equivalent sort of lithium units, power units, right? So we sort of think $1,750 to $2,000 is about the right price. So if that's the case with $1,200 now, that's a pretty big increase from here. So we're still pretty positive on lithium. We struggle to see lithium supply anywhere near what you see written up by some of the bulge brackets in the government. So we quite like that. We love copper. But it's hard to find, copper primary production in South America where there's more nationalisation going on than perhaps even Africa, right? So we like copper as well.
Yeah, I mean, you stole my thunder there. I think, outside of some of the critical minerals and, the outlook for demand for some of them is quite phenomenal. But for me, copper presents a much more assured, I suppose, outlook. It doesn't have the dynamics around, the electric vehicle market or renewable energy at its core, but it's so essential to all of these clean energy technology sectors that it's going to have a much steadier but strong uplift in demand over the coming years. And it's still a metal, which we struggle to develop. Certainly the issues in South America we've already talked about. But for me, that's probably the number one outside of some other critical minerals, which have seen, I suppose, the price fall in recent times and present some value. But I think copper's the number one for me.
Kate, I know that AMEC isn't in the business of picking commodities, but maybe I could ask what you find interesting in the market at the moment, where you think some of the opportunities might sit.
Yeah, so what I think is interesting is the different sorts of technologies for the battery chemistry and how there's lots of different opportunities to explore those different chemistries, and so there'll be lots of upside for all the critical minerals. because there'll be different use cases for the different chemistries. So you've got your solid batteries, and then you've got your automotive batteries, and there'll be lots of technology opportunities for sure. And for all those things, you're going to need copper.
Unfortunately, we're going to have to leave it there. We don't have time for questions. I've been a bit greedy with mine. I feel those, but would you please thank them for their time?